Okay, right. So thank you for joining us today. My name is Alexander Sokol. I'll be presenting this workshop jointly with the panelists today, whom I will introduce. The format today is there will be two sessions, half an hour each, on FRTB standardized approach. This is a standardized approach for the trading book, documents MAR21, 22, and 23. Tomorrow, we will do a similar workshop for the standardized approach for CVA and also basic, full and reduced basic approach for CVA, document MAR50. The purpose of today's session is not go step by step through every word of the document, and that would not be possible in a 1 hour format. The objective is rather to just recap what's new, what's unclear, perhaps, what's what the expectations are. So, the session today will introduce some of the issues with FRTB, some of the challenges, perhaps, that, some of the frequently asked questions that practitioners have been discussing for the discussion on the panel. And we will have two short Q&A sessions after each of the initial half an hour workshop sessions, and then we'll have a 40-minute panel where you will have the opportunity to ask panelists questions, offer your opinion. So we'll normally, in each topic, we'll take one answer from the panel and one from the audience. Even though the topic today and tomorrow is the standardized approach and the basic approach, however, as far as the panel is concerned, certainly any IMA questions are welcome. Comparison between standardized and IMA, really, anything goes. All right, so let me, before I start, let me introduce the panel. So with me today is, presenting this workshop is Christopher Anderson, economist, supervision and regulation, Federal Reserve Board, Thomas Obitz, director risk transform, and Jochen Theis, market risk specialist and independent advisor. All right, and with that, let's get started. I hope everybody can hear me okay. All right, one moment, let me share my screen. All right, so today we'll be discussing standardized approach for the trading book, right? And what are the objectives of the workshop? So first of all, we'll review the latest versions of the MAR21, 22, 23 documents and analyze the key assumptions that went to the regulatory methodology, especially where these assumptions may lead to differences to desk risk models, both in terms of how hedges are recognized and in terms how risk is calculated. And in that part of the workshop, I was inspired, I wanted to say, is by an article by Michael Pichtin about 5 or 6 years ago in Risk Magazine about a much earlier version of a different regulation, where he took a regulatory document for counterparty credit risk, I believe, and in this paper, he analyzed what the regulatory formulas were saying and essentially went back and reverse engineered them to what kind of model assumptions went in them. So essentially, he built a model that, with certain assumptions, produced the regulatory formula. And this was extremely instructive because, by doing so, he made it very clear what assumptions are being made. So in other words, instead of saying, take notional, take this, take that, right, multiply by this factor, he explained, okay, so the model actually, is a quant model. It makes certain assumptions, and by doing this, he was able to explain exactly what assumptions went in, and that started a discussion about whether these assumptions are, are consistent with the way that the desk risk is seen, whether they can be adjusted and improved. So we will try to do the same, even though clearly for the standardized approach, everything is much simpler, but we'll still try to understand the standardized approach in terms of how I would build the regulation if I was just starting from a normal risk model. And I believe that some of the analysis will be helpful in understanding how standardized approach works and what it does. Okay, and second, we will focus on areas of the document where there is significant degree of supervisory discretion, or if the intent of the document, has perhaps more than one feasible interpretation. And the purpose of this is to introduce these areas for the subsequent panel discussion, right? So in other words, things where the document is saying, let's say, if the supervisor decides to apply additional charge, or the supervisor may permit to reduce a multiplier. So that's one, category of questions. And the other category is where the intent is perhaps not completely clear. Let's say, it's saying something about one type of document, but one type of instrument, but it's not clear if a similar treatment would apply to a different type of instrument. Perhaps some clarifications is needed. And as I mentioned, it's not the objective today to go through every step of the standardized calculation, as it would be impossible to do in an hour. But we do have a set of simple examples in case the questions lead us there. We'll be able to show how each part of the calculation is done if it becomes necessary. All right, so first of all, historical context, right? So market risk in a trading book is defined as the risk of losses in both off and on balance sheet positions arising from the movement of market prices. All right, so continuous movements. Credit spread changes and issuer credit events are included. Counterparty credit events are excluded, and CV is also excluded. That's subject to a separate document. So the prices that go in are not inclusive of CV. Initial rule was published in January 2016. The current rule in January 2019, and the document numeration has changed at that point. Implementation schedule is not finalized, potentially 2022-23. So that's perhaps the expected implementation schedule is perhaps something that the panel may address. But right now, that's how it looks like. And our main focus is today is a standardized approach. Right? And standardized approach for a trading book is the default approach that does not require supervisor approval. Unlike for CVA, where the approach that doesn't require supervisor approval is the basic approach, and standardized for CVA requires supervisor approval, but not for a trading book. The capital requirement, as I'm sure everybody who dialed in have seen this formula, consists of three parts. The capital requirement under sensitivity-based method, which used to be called sensitivity-based approach. So now, we call it SBM. So the abbreviation SBM stands for sensitivities-based method. The default risk capital requirement, or DRC, and the residual risk add-on. Right, so the capital is sum of these three terms. We start from SBM. So the first one, standardized sensitivities-based method captures linear, Delta and Vega, and nonlinear, or curvature, risk of continuous change in risk factors for 7 risk classes across five asset classes. So the asset classes are rates, credit, equity, and commodity, and FX. But there are 3 different types of credit. That's why there are 7 in total. Varying liquidity horizons by risk factor type are incorporated into risk weights. So we'll go a little bit further into this a little later. But essentially, the reason there is a high risk weight, there may be 2 reasons. One is that the risk factor is very volatile, and the other one is not very liquid. If it's very volatile, it may change a lot over a 10-day horizon. If it's not very liquid, you may have to wait more than 10 days until you can unwind the position, and both of these contribute into higher risk weight. Difference between individual risk factors are not incorporated into the sensitivities-based method, right? So we'll talk a lot about it later, but essentially, this is not something like IMA or like desk risk models where you say, this currency is twice as volatile as another, right? So once you're within the same FRTB's, sensitivities-based category, right? So bucket, tenor, right? So in other words, if there are 2 risk factors that are assigned to the same silo slot, as other factors, they're treated the same, except as we mentioned for the occasional square root of 2 multiplier and so forth, and we'll talk about it a little later. Credit asset classes split across 3 separate classes, depending, and essentially, if you think of it as really, the split is based on how much trouble the respective underlying type caused during the financial crisis, right? From something like CDS, which caused some trouble, but not as much as others, then correlation and non-correlation based tranche-based instruments. Right. Second component captures the risk of credit issue events, again, so not counterparty risk, for which there is a separate regulation, and not CVA, for which there is yet another regulation. And finally, the residual risk add-on consists of 2 separate components, right? So this really, should have been 2 separate add-ons. They just combined together. So one is exotic underlying. outside the 7 risk classes in the sensitivities-based method, so anything for which there is no risk weight, and other residual risks, which include exotic payoff and a few others. All right, now, so the stated goals of the standardized approach is to serve as a credible fallback to the internal model approach, right? So it has a less, or at least, the expectation or the hope is that it will have less variability of capital charge due to methodology differences compared to the internal models. It will have definitely lower data in implementation challenges compared to the internal models. And it still has reasonable sensitivity thanks to hedge recognition buckets, etc. So the standardized approach in FRTB is head and shoulders above any alternative to IMM that previously existed. So the hope was that it will be something that more banks can adopt. Now, the challenges that have emerged since the first regulation was published, and some of them were addressed in the final rule as of 2019, is that, well, one of them is regulatory risk weights may not capture the difference in risk between individual curves, assets, and so forth, right, within the same categories that FRTB assigns them. Regulatory correlations, as well as some other aspects of the regulatory formula, may cause misalignment between optimal hedges for market value at risk, generally for desk risk essentially, and for between FRTB capital and optimal hedges for reducing desk risk. There is some variation in capital remains as a consequence of certain freedom that's built into the regulation, where there are certain things that are based on how the risk is reported by the desk. For example, do you use zero rates, do you use term swap rates, or essentially term instruments, base currency choice, and other choices that create variation of capital. And actually, there are two kinds of this variation. One kind is when a bank can make an election, a choice in implementation of the standardized approach that would result in different levels of capital. And FRTB has a lot of safeguards to prevent people just, shopping essentially for, a better method. Once you make a choice, you have to stick with it usually. Once you make a choice, it has to be for the entire bank. But still, there are some differences. And also, there is another aspect of that, which is two banks maybe managing similar portfolio, but observing different levels of capital. And one reason is that, especially if it's an international portfolio, your risk in one currency, in one reporting currency, may not be risk in another reporting currency. If I'm in Europe and I have euros, I have no risk for a cash position in euros, but I do if I'm in the United States. So some of it is natural variation of capital because, depending on how you define what domestic currency is in which you observe risk. But also some of it is also related to the variations, essentially, depending on how you choose your base currency, what your reporting currency is. There may be some variations that go beyond what's expected or appropriate given what your reporting currency is. And, we'll talk about a little bit later as well. Now, one thing which is interesting is that, and I'm not the first to observe it. In fact, I've seen multiple presentations pointing this out, is that FRTB does not always reward risk reduction when some upside is traded for some downside, which is, in fact, it's a very, very, some markets use it extensively. For example, equity option strategies are all about giving up some upside for reduced downside, spreads, straddles, and so forth. But also some, other markets can have the same effect. So, so this is something that we'll discuss in the final, in a second session of today's workshop, where residual risk add-on, the curvature term, not the residual risk add-on, I apologize. So the curvature term may work in a way that, in fact, will increase risk if you're actually reducing your actual risk as far as the outcomes that you can get from trading that instrument. And, as many have pointed out, it's a very conservative capital charge for trading exotic payoffs or novel types of underlying. And, perhaps it will have the effect of suppressing this type of trading. All right, so now with that, we go into the next into the first of the three components of the approach. We don't have, of course, equal amount of time planned for each three. So sensitivities-based method is the most complex part of the standardized approach. So we'll spend more time on it compared to the other two. So the first is the sensitivities-based method. Right, so the capital requirement under the sensitivities-based method is a set of sum of three components: delta, curvature, and Vega. And you may notice that I placed them in a different order from what they're normally placed, right? So normally you see delta, Vega, and curvature. Okay, well, the reason is that delta and curvature are linear and nonlinear part of the sensitivity to the risk factors. Vega is to volatility. So I believe it's more naturally to group them this way. So delta captures linear component, and curvature captures nonlinear component of the dependence of PV on risk factor levels for these 7 risk classes for which we have the risk weights. And curvature, despite its name, is actually not the second derivative, as you may think it's called curvature. So it's a stress test of up and down shift by the amount of risk weight. Right. So in other words, you compute the linear component, then you shift up by the risk factor, then you shift down by the risk factor, subtract the linear term, and look at how much nonlinear effect is there. And Vega captures the linear component for the dependence of PV on risk factor volatilities, again, for the same 7 risk classes. Right, so now if we look at the formula, so on top is the standard formula, it's in the very beginning of the document, well known, right? But I'm going to rewrite it a little bit just to draw the analogy between the sensitivities-based method and old, way, I would say the veteran of risk methodologies, the parametric VAR approach, which of course nobody really using today, because there are better methods, there are faster computers, and so forth. But in fact, it's very instructive to trace the roots of the standardized approach in how parametric risk is calculated. So let me do this, right? So I'm going to take basically square of this formula, right? We still need the max, which we don't need for the parametric risk. I'll explain in a moment why. And as you can see, that this is essentially a convolution or quadratic form on sensitivities with something which looks like a pseudo covariance matrix. It's not a real covariance matrix in the sense that it's not taken from covariance of historical observation of the risk factors. Nevertheless, it looks like a covariance matrix, right? So it doesn't actually it doesn't completely work like a duck, and maybe it quacks a little bit strange, but it is actually looking sort of like a duck-like bird, right? So now, first of all, why is the 0 needed here? Why do we have to max with 0? The thing is, covariance matrix, if you take it from the historical observation of the risk factors, is by construction the positive definite, or positive semi-definite rather. And if the matrix is positive, if this were real covariance matrix and not something obtained by a regulatory formula, it would have been from the very beginning positive semi-definite, and then you can show that no matter what the sensitivities are, you would never get a negative number on the right side of this equation. Because we're not computing this covariance matrix from the history, but rather it's a formula-based pseudo-covariance matrix. So that makes it possible, even though not very likely, but possible, that given the choice of sensitivities on the right side, you get a negative number. In this case, FRTB rightly limits it to 0. Okay, so now what does it? What does this formula tell us? And with that, let me just stop for a second. I don't see the chat right now, so let me open the chat window so I can see if there are any comments. And by the way, please feel free to ask any questions during the presentation. We will stop twice for a break. After the first half-an-hour session, of the second half-an-hour session, it will be a panel, but certainly I'm happy to stop and comment. All right. So it looks like there are a couple of questions. So one is, are FRTB risk weights the same as value as SIMS? They're not. They're different. How do you get sensitivities? You get sensitivities, I'll get to it in a moment, but basically by shifting risk factor values. And you can either shift and divide by how much you shifted, or you can use analytical approximations, AD, analytical formulas and so forth, even though the ability to use this analytical approximation was expressly clarified in an FAQ for the CVA, but not for the trading book approach. But I would assume that it would be acceptable. And finally, will it be double counting to have both SIM and FRTB? No, it should not be, because these are different, right? Okay, so now let me come back to the slide. All right, so why do we need? Why did it make sense to have this type of a decomposition? So the reason is that I'm trying to draw the analogy to parametric VAR. Okay, so again, so this formula is exactly the formula that you would see in a parametric VAR, except instead of the covariance matrix based on historical observations of risk factors, where it would give me, so diagonal of the covariance matrix is the variances, and the off-diagonal elements are the product of variances and correlation. So here we have what I would call a pseudo-covariance matrix, where it's a covariance matrix-like structure. It's a tensor, essentially, which goes across tenors, buckets, right? So it's a tensor if you treat tenor a bucket as a separate dimensions, but if you just pack it on, or flatten rather, into a single dimension, it's just a large matrix. And there's a regulatory formula to construct it. All right, so now, if Delta and Vega methodologies, it uses, both of them use the same quadratic form for sensitivities as parametric, quadratic form on sensitivities as parametric form, but with regulatory volatilities and correlations. So in other words, this pseudo-covariance matrix, it consists of pseudo-correlations and pseudo-volatilities, right? So what are the volatilities? Well, they're the risk weights multiplied by the square root of the liquidity horizon, right? So in other words, the risk weight is what normally, if you had parametric VAR, it would be the vol times the square root of the liquidity horizon. And then you can scale it, people may scale it, let's say, to 1 day, people may scale it to 10 days, but essentially, that's what it replaces, right? And the multi-step process of computing correlations within the bucket and tenor, then between tenors, then between buckets, and so forth. So that forms this regulatory correlation matrix. And one thing to notice, as I'm sure will not come as a surprise at all for anyone, is that SBM replacements for volatilities and correlations are highly conservative compared to the historical inputs in parametric VAR. So in other words, regulatory risk weights are higher than parametric VAR equivalents. Regulatory correlations are higher than parametric VAR correlations. And also, because FRTB uses 3 correlation scenarios, the capital has to be calculated with base correlations, low correlations, and high correlations, for which their formulas are provided. And then you take the worst of the 3. So that reduces the effect of hedges, because hedges, unless they're perfect hedges on the same underlying, they actually do depend on what correlation is observed. So this regulatory correlation may not correspond to the market correlation, even for starters. But then, by taking the worst of 3 correlations, base, reduced, and increased, you also further essentially misalign the hedges. And before anybody protests, I believe that's actually prudent and is done intentionally. The reason is that, as we know from the financial crisis, over-reliance on copula-based models and so forth, relying on correlations to reduce risk, as essentially anybody who studies Sharpe ratio knows exactly how it works. Essentially, you can enter into positions if you have a set of assets for which you know what the expected alphas are, and you know the volatilities and correlation. You can construct a Markowitz portfolio, which gives you the maximum return for the minimum volatility. Okay, well, sometimes it's done explicitly, as many hedge funds are trading exactly this way. Sometimes on a trading desk is done implicitly. In other words, nobody runs Markowitz optimization, but people, however, take into account that they can enter into 2 positions which are imperfectly correlated but this correlation acts to reduce risk. And during the financial crisis, during many of the largest, periods of largest loss, this reliance on correlation to reduce volatility backfired, because there is something called crisis correlation, where there is one correlation during normal times and another different, higher usually, correlation during the crisis. So relying on correlation to reduce your risk is something that fails you exactly when you need it, which is when you have a large loss. So I believe that there are some things in the standardized approach that perhaps are a side effect of making it easy to implement, side effects to reducing the data requirement. I firmly believe that this particular thing is not a side effect of any, is not an unintended side effect, but in fact, a feature. It's not a bug; it's a feature, as programmers say. It's something that was done intentionally and for good reason, right? Okay, but this being said, that's what it does, right? So using 3 correlation scenarios makes it a lot more difficult to reduce capital by trading things which are correlated in the right way. And finally, unlike parametric VAR, standardized sensitivities-based method does not differentiate between high and low volatilities or liquidity levels of individual risk factors within the single SBM category or silo. It depends on the risk class, but for interest rates, for example, is bucket plus tenor plus curve, except for the occasional supervisory multiplier of 1 over square root of 2, and sometimes there are other corrections there. For example, this 1 over square root of 2, you can apply. The bank has the right to apply. Sometimes they wouldn't, because it would increase capital, depending how you hedge across currencies. But the bank may apply this reduction in capital for specified currency and currency pairs, right? So there is some sensitivity that recognizes that some currencies are more liquid than others. Some currencies are perhaps less volatile than others. But it's not something where you have a table where you look up a currency and there is a risk weight per currency, right? So it goes by broad category. And that's a very important distinction. All right, now, let me just, perhaps at this point, it's a little bit less than half an hour, then nevertheless, perhaps a good time to stop and ask for questions. Does anyone have any questions? We did schedule 2 coffee breaks or question answer sessions, but certainly if not a lot of questions are there, we can leave more time for the panel. So at this point, I would like to pause and invite the audience, or anyone in the audience or anyone on the panel to comment, ask questions, and if anybody would like to get coffee, that's a good time to do that. So because of how Zoom works, there is no raise your hand functionality. So if you have a question, please either type in a chat that you would like you'd like to ask a question, and we'll unmute you, or type the question into the chat. I'll read it out, and then ask one of the panelists to comment. All right. So let's see what we have in the chat. Okay, so there's a question, would you have some sheets where examples are done, please? Yes, actually we do. And I wasn't, during the work, prior to the workshop, it was not entirely clear if this would be helpful as part of the main session. Because I think that for a workshop such as this one, there are perhaps somewhat competing objectives, and it's very difficult to fit everything into one session and not bore everybody. So we do actually have examples. They're in Excel form. We're planning to upload them together with the slides. And time permitting, today or tomorrow, we can perhaps go through them. But it's a very good question. So we did prepare a complete end-to-end, very simplified portfolio, and certainly there are all kinds of disclaimers there. Don't rely on it as a replacement of the MAR21-23 documents, because the spreadsheet example would be infinitely more complex if it tried to take into account every single sentence in the document, and that would make it completely useless. So we did not, in this example, attempt to cover every single footnote, FAQ, provision in a document. So it's just, a basic implementation of the standardized approach for a simple portfolio. And we have it both for standardized for today, for the standardized approach for the trading book, as well as for tomorrow, we have reduced full, basic, reduced, basic, full, and standardized approach for CVA. So we do have 4 spreadsheets, and we'll show them today, just a very high overview, perhaps at the end of the slide presentation. And they will be available for download with the materials of the workshop. All right. Any other questions? Okay, so if not, perhaps we can continue. All right, so now let's first of all look at correlations and risk weights of the sensitivities-based method, right? So that method is in MAR21 document, which, if you Google MAR21, that's the first thing that comes up, which is extremely well annotated, has FAQs and so forth. All right, so the sum of SBM components is calculated for 3 correlation scenarios, right? So these are the 3 correlation scenarios that I just mentioned, where you compute, you take the correlations that go into the regulatory formula. And these correlations are correlations within a bucket and correlation across buckets. And then you increase and decrease both of these correlations in the same way. And there are also correlation-like multipliers, psi, right? So these go into curvature. These are not correlations, but rather they just sign, right? So in other words, if it's a sign that reduces risk, you flip the sign and so forth, right? So there are 2 types of correlation, one within a bucket and the other one between buckets. And there is also this correlation-like multiplier, which only takes the value of 100% and minus 100%, but they enter into a formula in a way similar to the way that correlation would enter. Right, okay, so the 3 correlation scenarios, previously, if you started from 100% correlation, the increase, the high correlation scenario would not go any further up because you cannot go higher than 100% correlation. However, it did reduce 100% to 75%. And that actually caused the low correlation scenario previously in a 2016 version of the regulation. It caused the low correlation scenario to often result in the largest capital, simply because it was the largest change in correlation. In FRTB, most of the correlation tend to be very high, close to 100%. So because you have to cap at 100%, so that made low correlation scenarios stand out. And perhaps this was the reason why in 2019 correlation, the formula was changed. And here's how it was changed. So the correlation changes for high and low scenarios are written on a chart, and also, are written on a slide, and also there's a chart for it. Right, so blue is the base correlation, and it's x equal y, meaning that you start from your original correlation. So baseline, you just have your original correlation. Okay, so the green line is high correlation. So it's a minimum of 1.25 times the original correlation, and I'm using x to stand for either rho or gamma. Actually, okay, so there's a typo here. Actually, it should be min of 125x and 1. Let me just make a note of that. Right. Okay, so we'll correct it before the slides are distributed. So it should be min of 125x and 1, right? Because you cannot go higher than 1. So the green line, as you see, it hits at 80% correlation and hits 1 and doesn't change after that. Okay, now the low correlation has this formula, 2x minus 1. It's a max of 2x minus 1 and 0.75x. So the solid red line shows how it works. So it goes at the angle or slope of 0.75 until correlation of 0.8. And then it changes the slope and goes back to 1 when base correlation is 1. So in 2016, there was a different formula. It just had 0.75, and that's it. And I showed this formula by the dash line. So what happens here is that if you start from correlation that's close to 100%, and there are some correlations there that literally like 99.9%, and some of them are just happen to be high. So this drop in correlation, especially what it did in 2016 regulation, is that this 99.9% correlation is between curves for the same currency and for the same tenor. So let's say that you have curves for a different index. Let's say you have a LIBOR index and you have one of these new overnight indices. So the correlation between these curves on the base and high correlation scenarios was close to 100%, but it dropped all the way down to below 80% under the original 2016 formula for the low correlation regime. And that clearly created, significant impact, depending on how your portfolio is structured, but it has the potential to really, for this rates to diverge from each other very far, which normally, you would hope they wouldn't. So now the rule, has been changed. So now this nearly 100% correlation stays nearly 100%. And one can argue that in this case, perhaps it's even, I cannot even believe I'm saying this, but perhaps it's not even conservative enough at this point, because now this correlation that was 100% is still 100%. So standardized approach is no longer sensitive or takes into account the possibility of decorrelation of things which started off at 100%. And this may or may not be a good thing, given that again during the financial crisis, some things which were correlated become or nearly moved in unison no longer did. Also going further back in time, remember LTCM, where just before the introduction of the euro, have ever decided that bond yields in euro area countries would converge. And eventually, of course, they did, with short-term bond yields rather, and eventually, of course, they did, except that just before they converged, they widened. So, interesting policy question of whether it's really, something that should be taken care of in a risk framework, but, that's how it works right now. All right, now, the list of risk classes for the sensitivities-based method is general interest rate risk, credit spread risk, and there are three of them, right? Again, so there are three because these three types of credit trading caused different amount of trouble during the financial crisis. So as you go from non-securitizations, so what is non-securitization? Well, credit default swap is one example. Securitizations, non-correlation trading portfolio, right? So a securitization, non-CTP. Okay, so that's and finally securitization correlation trading portfolio, right? So this is something where so essentially non-correlation trading portfolio is where you have tranches, but you don't rely on correlation between multiple underlyings for your tranches to work. And the third one is when you do, right? So during the financial crisis, so this is what caused the financial crisis, the last one, right? And the other two, were affected is sort of almost like collateral damage, right? So there is an increased severity of the capital charge as you progress from first to second to third credit sensitivity here. And finally, there's equity, there's commodity, and there's foreign exchange. Now, anything that didn't get in there is subject to residual risk add-on because we don't know the risk weight, we cannot calculate risk. So for them, it falls back to risk based on notional, which is, of course, is extremely conservative. So if your risk class that you're trading is not on this list, that's not good news. It means that once FRTB takes effect, it will be expensive to trade that instrument. Of course, we anticipate that as years pass and new versions of these regulations are released, perhaps some new risk classes that become perhaps seem exotic right now, but become more standard in the future will not be treated under residual risk add-on. So there'll be either expansions of these risk classes. For example, right now variance swaps fall under the residual risk add-on, and perhaps one day they won't, and that would just be an extension of equity. Or perhaps this risk will eventually grow to things like weather and so forth if this type of trading becomes mainstream. All right, now the sensitivities-based method for Delta and Vega is done using these steps. And again, in the format of this workshop, it would not be possible for us to go through the entire document. This will literally would take hours. So just a quick summary. So you take sensitivities of the financial instruments, which the document prescribes to compute as finite difference, one-sided finite difference, but the expectation is that you should be able to use other methods, such as analytical formula or AAD. And you calculate the sensitivity to each applicable risk factor from the prescribed list of risk factors that is provided in the document. Okay, so then sensitivities to the same risk factor are netted to give net sensitivity across all instruments. The sensitivities are risk weighted by multiplying the corresponding risk weight to the sensitivity. So this is very similar to how in parametric VAR you take the sensitivity and multiply by the volatility in the square root of the risk horizon. And finally, these weighted sensitivities are aggregated in each bucket using the prescribed correlation metrics. So if we are trying to understand the standardized approach in terms of parametric VAR, this step is this is the step where you multiply by volatility, and this is the step where you multiply by correlation. Or you can alternatively multiply these two together first, and then you have a covariance matrix. You get the same answer. Right, and finally, the capital requirement, or the risk position rather, is KB, is aggregated across buckets within the same risk class using cross-bucket correlation matrix, and then the total risk is a sum of all of the risk positions. Now, the definition of sensitivities of Delta and Vega MAR21 using the shift of 1 basis point to 1%. Okay, and initially, I remember, years ago, there was a lot of debate on whether this one-sided formula is an illustration or something you have to follow. And the reason is that 1% for certain underlying types is actually a lot. Like, for example, if you have a barrier option on FX, and a lot of FX option on barrier, that's very, unlike other markets in which barrier options are more of an exotic or structured trade, like in interest rates, in FX barrier option is commonplace and is a large part of how people trade. So if you have a barrier and you're shifting the FX rate by 1%, that's actually a pretty significant shift. If you just calculate infinitesimal sensitivity delta, well, that's not it's exactly going to be the same if you're very close to a barrier. Okay, now the question is, what's intended? Well, the standardized approach already has something that's a stress test when you shift by the risk weight. Right, so you shift by the risk weight in curvature. So here, the purpose of the sensitivity-based method is, as it says, sensitivities, right? So it should be delta. It would not be, I think, logical to assume that there are two stress tests there. One when you shift by the risk weight, which is also different for each of the risk classes. In the other, where you shift by 1 basis point to 1%, which is not differentiated across risk class of, and definitely the shift of 1 basis point or 1% does not seem like anything that's finely tuned to produce some sort of a desired effect. So even though, to my knowledge, there was no FAQ specifically for the market risk in the trading book that would say that, yes, you can use analytical sensitivity, you can use, perhaps smaller shift, you can use two-sided shift and so forth. I fully expect that it will be permitted. And for CVA, it was actually explicitly clarified in an FAQ, which said that you can use analytical or you can even use a joint algorithmic differentiation, which is a fast way to compute multiple sensitivities. So we expect that it's really the sensitivity that you need, not the finite shift by 1%. And the formula simply illustrates how to properly scale the shift. And kind of the only thing that's here that's kind of a little complicated is the document says that the bank may choose sticky strike or sticky delta approach to access delta charge in a perfectly hedged position. Okay, so so here it's a little bit more difficult to understand exactly what to do in some cases, because on one hand in the document it says shift one risk factor, hold all others constant. And then here it says choose. You can choose sticky strike or sticky delta. Well, sticky strike is exactly what the beginning of the document says. You shift the volatility, you keep the stock price or the underlying price constant. You shift the underlying price, you keep the volatility constant. That's what's called sticky strike. So that's not an issue, right? Sticky delta is a little different. So here, if you shift the underlying, you also have to shift the volatility, essentially moving along the, you're moving along the smile curve. And if you do that, then you're not really keeping all of the other risk factors constant. You're also shifting one more risk factor. So the current consensus, I believe, is that this prevails, right? So in other words, in the beginning it says hold all other risk factors constant, but really should have said except when you're using the sticky delta method. So that's how I believe it should be interpreted. And finally, there is no Vega for instruments with convexity alone, only for options. So if you look at the MAR document, there are 4 situations in which the document explains there are 4 cases when you do not need to compute Vega. So one of them is when the instrument does not have any options. Okay, so the thing is, and as all of us know, especially with the LIBOR reform, upon us, there is this thing called convexity, which is the dependence of PV on volatility, even if there is no option. It may also happen due to misalignment between the term of the interest rate and the length of the period to which the interest is applied. So for example, if you have something like a CMS swap, where constant maturity swap, where you're paying not LIBOR or not your index, but you're paying the swap rate, so that has significant convexity. There's also some convexity when using the overnight average instead of, again, so the rates such as LIBOR. So there is some dependence on volatility for instruments which don't have the options, but you don't have to include it in the standardized approach unless you want to. And the reason you would want it is just, again, if you believe that your hedges would be better reflected in your capital requirement if you did that. All right, so let me just look at the chat. So I see that there is one question. What about, the question is, what about some hybrid types, such as commodity ETFs inside equities book? Is there room to choose which class to capitalize? Yeah, in fact, there isn't, but commodities, oh, I see, right, okay. I apologize, right, so now I understand the question, right? Okay, so the question is about the following. It's actually an interesting one, right? So if you're an equity fund or equity trader in a bank, you trade ETFs. Some of these ETFs are actually linked to commodity underlying, right? So in other words, it's an ETF which is linked to commodity underlying, and it tries to, there are some interest rate ETF, there are some, so essentially it's an exchange traded fund which is linked to underlying, which is not equity. So let me table it for now. That's a very important question. Actually, we're going to get to it when we talk about look-through. So there are some provisions there that actually potentially may apply. So I have a slide on that, and I also wanted at that point to actually ask the panel for the comments. So I will answer that question when we get to that point. So, but thank you for asking. It's actually this way. It is a very prudent question, given that these ETFs are extremely popular right now. Okay, so is FRTB calculated on the bank's entire portfolio level or counterparty level? Okay, so again, reminder, this is not counterparty credit risk, and this is not CVA. So this particular regulation we're talking about is for the market risk of the trading book, where when you value the trading book instruments, so again, this is not banking book. Even if the bank's treasury holds, let's say, may buy some bonds, may issue some bonds and so forth, so that's not part of it. So that's a trading book regulation. There are separate banking book regulations. And this excludes CVA, it excludes counterparty risk. So it's computed on the portfolio level, not on the counterparty level, because it does not deal with counterparty credit risk. And for CVA, we'll be talking about CVA tomorrow, right? So this question would be appropriate, right? And the other question is there any consensus on convexity curvature versus vis-a-vis hedges? Okay, so I'm not sure I understand the question. Perhaps if we could reopen it during the panel discussion, and this is a participant with initials DG. So perhaps at that point we will invite you to clarify. So I'm not sure I understand the question at this point. All right, so so let's continue. Right, so few things in risk classes, right? Few things with the risk classes. First of all, when swaps are not liquid, right, which is common to emerging markets, the risk-free curve may be derived from sovereign bonds. Okay, so that mixes up the CSR class for non-securitizations and the interest rate class. Because if you're looking at a sovereign bond curve and using it as a risk-free curve, this curve has the interest rate component and the credit component. So the document says that if you're not able to perform decomposition of this curve into the interest rate part and the credit part, then you would have to apply risk weight to both. So this will have the effect of a much higher credit risk weight applied to the instruments which are not really sensitive to that credit. Right. So in other words, you have the risk-free curve, which is just used for discounting, and it should not really be attracting the credit risk weight, but it does if you use the sovereign curve to build the risk-free curve and don't separately take into account the credit component. And extracting the credit component from the sovereign curve is actually easier said than done, because the reason that you went to the sovereign curve in the first place is probably because just purely interest rate money market instruments were not liquid enough. So in this case, most likely you also don't have a sovereign CDS, or you may have sovereign CDS which is denominated in a dollar and not in a local currency. And if you know, in this case, and it's a very well-known effect, the price of the sovereign CDS also depends on what the traders think about the likelihood of the currency devaluing in the event of a sovereign default. So then it becomes more difficult to extract the risk-free curve from the CDS, even if it exists, but it may just not exist or be not sufficiently liquid. So it's actually an interesting question, and it was submitted by a workshop participant ahead of time. So we will talk about it a little bit more. It's one of the panel questions that we're going to address in the panel. All right, now we going to correlations, right? So we finished with initial overview of sensitivities, going to correlation. So again, so these correlations are pseudo correlations that go into this form. So if you're thinking of parametric VAR, which all of us are familiar with, so this is the correlation that replaces the historical correlation, except is based on a regulatory formula. Okay, so we'll start from correlations between tenors within the bucket. So one thing that I wanted to emphasize is that in FRTB, bucket is not what you normally think about as a bucket if you're an interest rate quant. So in interest rate, bucket normally is the segment of the yield curve by maturity. But in FRTB, bucket is currency. In other words, it has to do with your type of underlying. The maturity-based grouping of risk factors is vertex or tenor, right? So when you look bucket, and if you're from interest rates, it's pretty jarring because you're constantly thinking about the wrong thing. So bucket is not the same here, right? So we'll be talking about vertices or tenors as far as maturity, and buckets are things like currency. So that's the difference, right? And the delta risk correlation between sensitivities within the same bucket, but with a different vertex or maturity tenor, is given by this formula. So it's exponent minus alpha, which is 3% of the absolute difference between the tenor in years divided by the minimum tenor year, and 40%. Okay, so I'll have a table in a moment, so please don't try to figure out how it works. But if you plot it, it's pretty clear. And between two sensitivities within the same bucket, for example, the same currency, different vertices and different, actually it should be same vertices. So same bucket, same vertices, again, it's a typo, and different curves. The correlation is equal to correlation parameter. Actually, no, I'm sorry, I apologize. Okay, so I thought that's a typo, but actually it's not, right? So same bucket, different vertices and different curves, you take this correlation and multiply by 99.9%, right? So the slide is correct, actually. Same bucket, same vertex, different curves, 99.9. Same bucket, different vertices, same curve, this value, and then different vertices and different curves, each is a product, right? So you lose a little bit more of correlation if you go to a different curve. Right, now, let's start from this 99.9%. Okay, so here's how 99.9% looks in practice, right? So I generated some random numbers which are correlated at 99.9%. So you can see, you know, this was kind of obvious, right? So 99.9 is actually very high correlation. And when correlations are this high, the two risk factors move in nearly the same direction, except when the move is very small. So now that's the baseline scenario. So under the 2016 rule, low correlation scenario ended up at 75%, right? So this correlation of 99.9 in a low correlation scenario under the former, no longer active 2016 rule would have gone to 75%. But under the 2019 rule, low correlation scenario is 99.8. So if you look at this formula that we had a couple of slides back, which says is the maximum of 2x minus 1 and 0.75 times x, when you're close to correlation of 100%, 2x minus 1 wins. And 2x minus 1, if you're starting from 99.9, you get what? 99.8. So this is correlation in low, high, or in either low or high or base correlation scenario. This is nearly 100% correlation. So the document requires us to take this into account. I don't believe capital for a single trade, you know, if basically there's a simple portfolio of a couple of transactions, really would be very different if this was correlation, which is set to 100, which really be equivalent of saying that you're just going to have all of the curves for the same currency shifted together. Perhaps this 99.8 can, as a result of you know, building up a larger regulatory correlation matrix, have larger effect as the portfolio gets more complex, because in large matrices there are various effects that don't happen in small matrices, and certain in generally, again, so anyone who tried to build in the context of historical VAR or parametric VAR, or you know, modeling, you know, building a Markowitz portfolio, as anyone knows who tried to build a positive semi-definite correlation matrix for more than 10 or 20 risk factors, the larger the matrix, the more sensitive it becomes, or rather the generated time series or the risk, the more sensitive it becomes to very tiny changes in individual correlations. So I believe that when the matrix gets large enough, there may be significant differences in some cases between 99.9% and 100%. But this will not be really a big difference if there are only a few transactions in the portfolio. Right, so there is a participant question. It looks like FRTB is similar to OTC initial margins. SIM, okay, so isn't it double counting to have both SIM and FRTB in the OTC trades? Okay, so just to answer this question, so these do different things. So first of all, SIM is initial margin posted to the central counterparty. So somebody central counterparty needs to make sure that if the market, you know, if the value of your trade moves, they don't lose money. So this is for the bank itself. So the capital that the bank itself holds to make sure that the bank does not become insolvent. However, you know, both of them are based on the move over a 10-day risk horizon, or in some cases a longer, depending on the risk factor, longer risk horizon. So both SIM and FRTB, or standardized approach, or actually the entire FRTB, the market risk regulation, protect against moves of market risk factors over the liquidity horizon, which in this case for SIM is 10 days, and you know, and for some risk factors is longer. However, the purpose of the calculation is different. So yeah, there is some similarity because both of them are basically based on VAR, and both of them have elements of using regulatory you know, methodology instead of the pure quant methodology based on pure calibration to the market. So there is that degree of similarity. I agree. All right, now back to the slide. All right, so correlation between tenors. Right. So here I plotted historical daily swap tenor correlation. And this is a 5-year observation period because I wanted to make sure that we don't just have the recent near zero rate liquidity trap regime versus GIAR the regulatory correlation metrics. Okay, so the way to read the slide is that on the left on top, I have euro, historical correlation between tenors, and these are the swap rates. So I'm using not zero rates, but swap rates. On the right, I have GIAR for the same tenors. On the left, I have South African rand as an example of a currency that is not, in the liquidity trap regime. And here's also GIAR. So actually, on the right, two matrices are the same, except one of them has an extra tenor. So I put it here twice just so it's easier to compare. Okay, so what do we can see here? All right, so if you look at the euro, right, there is, of course, 100% on a diagonal for all of these matrices, right? Correlation of something with itself is 100%. Okay, now let's look at the correlation between 6-month verdicts and a 30-year verdicts, right? So the question is, there's a short rate. In case of euro, that's actually the LIBOR rate that goes into this. This is the LIBOR rate, the index that Euribor index that goes into the swap. In 30-year verdicts is the swap rate. So what is the correlation between the short rate for 3 months and the long rate for 30 years? Okay, so ordinarily, you would expect that this correlation was positive, right? Because generally, if you have higher rates today, then the traders probably anticipate higher rates tomorrow and next year and the following year, and they will say, okay, so the long rate also should go up. But the longer you go in the future, the less connection there is. And the reason is that the traders, they think that a lot can change, right? Or if you think, to understand why this correlation in practice is very low, you can think about the following. Let's say we're sitting here today, right? It's 2020. Okay, so now the question is, how much interest rate today, short interest rate today, really depended on what was in the 1990, right? Anyone remembers 1990? That was a long time ago. So today, the short rate does not really have much memory about what happened 30 years ago. And for the same reason, if you're thinking about, well, what's the swap rate? Well, swap rate is actually, we're not just looking at the forward rate at 30 years. Of course, it's an average that has a little bit. If it's a swap rate, it has a little bit of a rate tomorrow. It has a little bit of a rate 1 year from now. So the average maturity, of the forward rate that contributes into 30-year swap is around 15 years. But still, 2005, right? Rates were high, rates were low. So the longer in the future you go, the more you forget about the short rates, right? So if there was a 50-year swap, 100-year swap, you essentially would, not really remember much about what happened 50 or 100 years ago. So the further you go in the future, the less there is connection. That's why the long end of the curve moves relatively independently from the short end of the curve. And that's why, by the way, single factor, interest rate models are not great for certain types of transactions. And this correlation gets very small. So you can see here that it's 10% for the euro, right? Interestingly, for the rand, it's actually even minus 4%. Well, minus 4% is I don't think there's any economic reason why higher short rate should go, should cause a lower 30-year rate. Normally, you would expect them to move in the same direction. Perhaps there is an economic theory that explains that, but I think that's more likely just noise, right? So in other words, it's really close to zero. So the thing is, the GIAR correlations between 30 years and 6 months is 40%. That's floored, right? So if you remember this formula that we had a couple of slides back, is floored at 40%, right? So now we apply this formula. So we can see that these correlations when you're near zero, right, they're here at 40%. So that's one big difference. Okay, so the other big difference is if you look at the correlation between 1 year point and 3 month point, right, so it's only 23% here, right? 50% between 1 year and 6 months, 23% between 1 year and 3 months, right? So here it's respectively 97 and 91. So again, much lower correlation in the historical data. So the standardized approach takes extremely conservative view on how different risk factors are correlated, and interest rate factors for different vertices is not an exception. And I believe that this is intentional and serves to protect against making the wrong assumption about correlation. In other words, if your portfolio assumes this low correlation to reduce risk, well, in a crisis, these correlations can skyrocket. So generally, it's definitely the right approach. However, it also means that that your perfectly hedged portfolio, which has very low desk risk, may actually attract significant capital charge because this offsets, or rather the lack of correlation that you're assuming in your desk risk is not going to be assumed by the standardized approach. So really the only corner of the matrix where it's similar is the right corner, right? So example, between 10 and 30 years, it's 93% here, 94% here, 96% here, right? So that's kind of a good corner in which we have perfect match between the historical correlations and regulatory correlations. However, in the upper left corner or here, between, basically 3 months to 1 year, 2 year, and so forth, as well as shorter end to the longer end, there's a significant difference. And that causes the difference between desk risk and what the standardized approach would do. All right, now the second comparison I would like to make, just before we finish with the interest rate sensitivities, is the risk weight comparison. Okay, and we're going to compare risk weight to the standard deviation of daily returns scaled to up to 10-day expected shortfall at 97.5% confidence level. So we scaled the standard deviation by a multiplier to get expected shortfall 97.5%. And I wanted to emphasize that this is not actually a replacement for IMA, for the simple reason that we're not calibrating to the stress period. We're not performing some extremely complicated calculations there and so forth. So this is not a comparison to IMA. This is simply scaling the standard deviation to get a feel for what expected shortfall you would find if you had a normal distribution with the observed historical volatility relative to what the risk weight is. And that's all it does, right? So it's not, again, I emphasize, it's not a comparison to IMA because IMA has a lot more to it, including the stressed calibration, right? So this is non-stressed expected shortfall. Well, here's the thing, right? So there are some vertices here. And again, so the good side of this matrix is the longer term, where you expect a shortfall at 10-day horizon, and the risk weight, are similar, right? So this is 0.56. That's less than percent, right? So 0.50 is about 0.5% versus about 1%. So the risk weight is about twice the expected shortfall for the 30-year bond, on the South African rand. The risk weight is about twice the expected shortfall to 10-day horizon observed from a historical volatility. That makes sense. It's conservative by a factor of 2. Okay, right. Well, here it's conservative by a factor of about 3, right, at the long end. Also pretty reasonable. Okay, well, here's a bit of a trouble, right? So the risk weight in GIAR for the basis, right? So the basis curve is the basically the spread in a cross-currency swap. So the thing is, if there was no cross-border friction and all of the conventions were the same, then the cross-currency basis would be exactly 0, because you have a floating leg on one currency, you have floating leg on another currency. As anyone who attended the mathematical finance course will tell you, that the price of the swap is 0 because both of these floating legs are equal to the difference in principals, and as long as there is a principal exchange in the end, that all adds up to 0. So the cross-currency basis is exactly 0 if there's no cross-border friction that causes it to emerge, and as well as some of it is just the conventions. Right. So the thing is, it's hard to imagine that this becomes very high, but yet it attracts the risk weight that's actually comparable to the risk rate of the interest rate itself. So here we observe it, right? So for the Australian dollar to USD I just took different currencies just so we're not focusing on these two. So Australian dollar to USD cross-currency basis, the expected shortfall is 0.12, but the risk weight is 1.6. So that's actually 15 times higher, right? So for the long time horizons, reasonable degree of conservatism for the rates, but a lot higher degree of conservatism for the cross-currency basis, right? And for the short rates, well, the thing is, we're now in the liquidity trap regime. So the rates are near zero. They also really historically don't move much, right? And this is why here again, this is 0.04. So this is actually 30 times lower. And perhaps it should be, because eventually we will depart from this low rate regime. So here it's extremely conservative, but for good reason, because historically, when the rates are in liquidity traps, they don't move. However, when they do start moving, they can move very rapidly. So I think that 1.2% for the short rate is pretty reasonable, right? For the South African rand, they're not in liquidity trap, they're positive. So again, this is a little bit higher, still conservative. So for the interest rate, you can see how conservative it is, and that's kind of meets expectations. It's exactly what you would have expected. But for the cross-currency basis, you can see that it's tremendously conservative. And of course, you can see that this risk weights are different between euro and ZAR, and that's because the risk weight is reduced by a square root of 2 for certain currencies. All right, now the specified currencies and currency, there is a group of currencies and currency pairs that have risk weights reduced by a square root of 2. This is the list of currencies. This is the list of pairs. So the lists appear to include some relatively risky pairs and not include less risky pairs. Now, the question is inclusion of currencies in this list driven by the lower volatility or shorter liquidity horizon? Are they more liquid? Are they less volatile? Will the list change if a previously safe and liquid currency becomes more risky or illiquid due to a fiscal crisis? So what happens if one of these currencies becomes really, an illiquid currency, right? So would the document be amended? So that's a, a very interesting question. So we'll discuss a little bit on the panel. Now, here's another slide. Again, so I'll just go very quickly because we're going to discuss it in the panel. So that goes back to the CTF question. So in 2016 rule, you had to use the look-through approach. So when you have an index, you had to, and for which you know the individual constituents, as you do for the ETFs, you actually required to go and calculate sensitivities to the individual constituents. However, in 2019, there are certain broad market indices that are carved out, right? So respective weightings are known, index contains 20 constituents and so forth. So this looks like tailor-made for things like the S&P, let's say ETF, right? Or S&P, any type of S&P index or similar index-based investment. Now, the thing is that a lot of ETFs which are based on factors, perhaps are not as well known as S&P ETFs or other broad market ETFs, but there are there's a thing called factor investing. And these factors are not all in the same direction, right? So there are long, some long positions, some short positions. That definitely excludes them. Also, there are a lot of criteria here. So I think an individual fund investment can easily run afoul of one of these. So we'll discuss it on the panel. It's a very interesting question. One of the big I think question marks in exactly how the regulation will be applied. And finally, one thing there is that there is a base currency choice that affects your capital. So what happens there is that there is as I mentioned, so there is a valid reason why banks and different currencies may have different risk for the same portfolio. Let's say foreign exchange transactions. The reason is that if I am in the euro area and I have cash position in euro, that's a risk-free position for me, but not risk-free for someone who is in a different currency. They may make profit or loss, but depending on the euro effects to that currency, but I don't care about it if I am in the euro area. However, a bank can also choose base currency that's different from the reporting currency. Why? Because a lot of market data is not available. A lot of market data is a lot better and more readily available to a different currency than your reporting currency. So the bank may choose under this regulation, but not, by the way, for CVA, there is no equivalent clarification, to choose base currency different from the reporting currency, calculate capital, and then convert capital to reporting currency. Well, the thing is that it makes a little bit, it makes a difference in the capital. And this is an example with two foreign exchange transactions, which are in British pound and South African rand, and seen from the point of view of American bank and euro area bank. And as you can see, the blue is the US bank and the orange is the euro bank for which euro is the reporting currency. So you can see that there is not quite 50%, but probably about like 30% difference. That's a significant difference in both, in all three correlation scenarios. So base currency choice actually does have an effect, even if you take into account the risk of the conversion to base currency. And that's something that perhaps should be considered when the bank makes a decision of whether to use reporting currency or a different currency for the standardized calculation. Finally, let me just see how we're doing on time. A second. Okay, so yeah, so we're running a little bit late. We took some questions, so we'll probably start the panel about 5 minutes later than we initially planned. All right, so at this point, I probably should stop taking questions, so we don't delay the panel even further. So all of the remaining questions, so please ask the questions in the chat, as many people have done, and we'll address them during the panel. All right, so the curvature charge. So we're now to the third component of the standard, right? So the curvature charge appears when position has excess loss relative to the linear position, right? So if the payoff is linear and the risk factor, there is no curvature charge. Now the question is, why calculate linear and nonlinear parts separately? Well, it's probably a little contrived, but you can see that you can just happen to have low risk at plus minus risk weight, but still have a lot of risk. So you separate it out. But really, the main reason is that, other than this contrived example, is that you have to do a lot more calculations or pricing evaluations of the portfolio for the curvature. So in a lot of cases, delta is applied at the individual vertex level, but curvature is applied by shifting the curve in parallel or shifting the curves together. So curvature is simplified, and that's why it was separated out from the sensitivity delta approach, where it has a lot more risk weights, whereas the curvature uses basically flat shifts where delta did not. Okay, so how the curvature is designed to work, right? So curvature is essentially the excess loss that's above delta, right? So if delta, essentially the way that delta works is that if you see my mouse, so this, what I'm showing with the mouse right now, is the loss due to delta, right? From 0 to the dash line. And curvature may add to it. And here in this example, the convexity is such that you lose money relative to delta in case of a negative shift or the positive shift. And the larger of these losses is contributing to the curvature capital charge. Well, the thing is that the way that it works, which is clearly working properly in a lot of cases, but it does, however, penalize trading upside, penalize trading or substituting some upside potential for the reduced downside risk. And there are a lot of types of trading in which this is exactly what traders do, right? So if you think about equity options trading, all of the equity option strategies, like things like spread, various spread trades, they're all about selling some option, but because selling a call option basically gives you unlimited downside potential, then selling some other options in order to limit your downside potential, which also reduces your upside potential. And that's exactly where curvature charge is not your friend. So this is an example. Again, not my example. I've seen it in a presentation, but it's extremely instructive. So if your payoff looks like this, which is really just a bear spread, right, a very typical strategy, your max loss will happen here relative to delta. And sorry, your loss relative to delta, CVR minus, right, your curvature correction, will happen here and may exceed your maximum loss, right? So in other words, your maximum loss is limited by this. However, here on the opposite side, your value of your position is relative to delta, but the regulatory formula for curvature does not tell you that curvature correction is thrown away when there is no actual loss, right? It only looks at the loss relative to the linear delta approximation. So curvature only looks at the loss relative to the dash line and not relative to the actual, initial point, right? So you can have positive P&L, but still a contribution to curvature. So here, a very simple, it's not contrived, it's just a bear spread trade. it has greater curvature capital than the maximum loss. So that's an example of how it can backfire. Right. Other than that, it's very straightforward. Okay, and finally, let me go through the through a couple additional slides. So we're rapidly nearing the end of the main session. So I spend most of the time on the sensitivities-based method because that's where really the greatest number of challenges occurs. So default risk charge, I'll just summarize in a couple of slides, but we can discuss more in the panel if there are questions. Right, so captures jump to default. And the risk, because the risk of credit spread change is captured separately in the CSR risk class of sensitivities-based method. So this is the jump to default. In ours, the issuer has to default for this charge, or rather the probability of issuer default is exactly what charge is about. And there are three different capital levels in hedge recognition rules for the three portfolio types, right? So in proportion of how much trouble they caused during the financial crisis, and the level of conservatism increases from the first to the third, and becomes very onerous, where you can do less recognition of hedges, you can have higher risk weights, and so forth, and etc. Right? And there is reason why hedge recognition and the default risk charge is so incomplete or intentionally suppressed. Before the financial crisis, a lot of banks were hedging credit exposure to Lehman with CDS, so not the major banks, right? So that, I don't want to oversimplify it the way that some journalists did by saying that the copula model caused the financial crisis. But certainly, if you're using a copula to build your hedges based on correlations of credit spreads, you're in for a surprise when there is a crisis, because then eventually one of the names may just default to the credit spreads may widen, but not the others. So hedging exposure to one credit name with an instrument on a different credit name, even if it's a peer firm in the same financial sector or another sector and otherwise very similar, is not good, because one day one of them will default and the other one will not. So that's what essentially DRC helps to do, right? So DRC has a hedge benefit ratio, and there are various kinds of safeguards there to prevent even taking into account any hedges on different names, especially for this more, for the second and third types. But also, furthermore, even if you have the perfect match in your hedge, what the obligor, what the reference name is on your hedge and on your transaction that you're trading, depending on how many long positions you have, when you essentially long position means that long or short means that you're buying protection or selling protection. So depending on how much protection you bought and how much protection you sold, your hedge benefit ratio is not perfect. And again, because of the financial crisis, because a lot of firms bought CDS from, let's say, AIG, and AIG was at risk of default. So even if you have credit protection on the very name that you're trying to hedge, whoever sold you this credit protection may also become insolvent. So the hedge recognition is not perfect, and rightly so. Right, and finally, just a couple of slides on the residual risk add-on, and we'll go to the panel. So it is a residual risk add-on is anything that there are basically it's calculated on all instruments bearing residual risk separately or in addition to other components, right? So obviously it's not a replacement; it's an addition. And the calculations rule is simple. It's just 0.1% or 1% of the notional. But the rules to determine when residual risk add-on applies is where the complexity is. Right, so it applies to some exotic underlying, but not others. To some exotic payoff, but their exception. Excludes back-to-back trades. Excludes any trade eligible for clearing, even if the bank didn't actually clear it. So residual risk add-on, correctly calculating it, is about the rules when it applies, not about multiplying the notional by 1%. Okay, so now there are two types, right? So really there is residual risk add-on 1 and residual risk add-on 2. So the first one is due to exotic underlying. Right, exotic underlying is anything outside the risk classes that we have. So it's defined as anything outside both sensitivities-based method and default risk charge. Includes things like longevity risk, weather, natural disasters. Okay, fair enough, right? Okay, well, it also applies to variance swaps, right? So MAR23 document specifically says future realized volatility is underlying for a swap. That's a variance swap. Well, these are highly liquid instruments that can be hedged, as we learned from Risk Magazine this year. can be hedged along with vanilla options. So, somewhat surprising. It could potentially end up in equity, but right now there's a residual risk add-on on that. And things like prepayment and other types of behavioral risk. And there is a residual risk add-on on other risks, right? So that one is a smaller, right? So if it's one of the existing risk classes, it's not 1% of notional. Like here, it's 0.1. But exotic payoff, anything that's not linear or vanilla, and vanilla is defined as call and put, right? So digital evidently is not vanilla, right? Even though there are some questions about that. Gap risk, right? Significant change in Vega in response to small movement of the underlying. Okay, so barrier and digital, that's fine. Path dependent options, okay, well, barriers meet the criteria, but MAR23 specifically mentions Asian options. And that's really surprising because what Asian option does by averaging the underlying for the purposes of payoff, it actually reduces the gap risk. It doesn't increase it. So Asian options have less gap risk than a vanilla option, yet vanilla option does not attract the residual risk add-on, and Asian option does. And that is a surprise. And correlation risk, except for multi-underlying European or American plain vanilla option, including relevant index options. Okay, so the specific options listed in MAR23 are basket options, best of options, and so forth, right? So, well, there is a pretty small difference between the index and the basket, right? So the question is index is published, right? But there are some baskets that are really replicating the index. So I think relevant, it's an interesting question. What does it exactly mean? And there are a couple of carve-outs where you would think that residual risk add-on would apply, but it doesn't. Cheapest to deliver risk, small risk, correlation risk, but only for certain option types. And dividend risk and equity instruments, right? So in other words, dividend risk in your equity call option is not subject to residual risk add-on, except when all you have is dividends. Actually, there are these trades that like that, where you strip out dividends and sell them as a derivative. So this is the end of the main presentation. It looks like we have, so we're a few minutes late, but almost on time. And with that, we'll go to the panel. So with the panel, we have two types of questions, and also we have additional submitted questions. So the first kind of questions are what we call workshop questions. So these are the questions that the panelists came up with. And they're also submitted to participant questions, where these are the questions that were submitted by participants in advance. Plus, we also have questions submitted during the session. So with that, let's go to the panel. I already introduced the panelists, and thank you for joining us today. And I'll start from the first question. I'll ask the panel if anyone likes to comment. And also we will be taking also, if anyone in the audience would like to comment, there's no raise your hand button in Zoom, but you can type into chat that you would like to comment on a question. So please go ahead and participate in the discussion. You're very, very welcome. So now we'll go with the we'll go to the panel. So I think that the first question on will FRTB change your trading business? Well, I think it's a very fundamental and broad question. But I would qualify it as slightly again. So the second part is important here. FRTB will trade the changing business. So the question is how. So I wanted to ask the panelists, what is in your view, is the main area of impact? In other words, how will the trading business change? What will be the most important or most widespread change when FRTB takes effect? All right, anyone from the panel would like to comment?
I mean, maybe just go first. I think that there's several things that are going to be quite wrenching changes. One is clearly FRTB touches on a lot of operational details of how you run your trading business. So you one almost inescapable consequences that you have to basically look at everything from your booking model down to how you set up your desks and potentially reorganize your trading business. And the other aspect is that the capital charges for what you're trading might actually quite dramatically change depending on what it is. It's there's a lot of detail to go through, but you could find that certain types of trades no longer pay. Other types of trades suddenly become more attractive than they were. And also some macro hedging strategies that used to work under Basel II may no longer work at all. So because the offsets between different asset classes are no longer allowed. So I think those are the three main areas where we'll see changes. How big they're going to be really depends on how you set up.
Okay, thank you, thank you. Anyone else would like to comment? Anyone from the audience? All right, yeah, so, okay, thank you for the comment. Yeah, I agree completely. All right, so the second question is, does standardized approach encourage excessive risk-taking in most volatile markets? So let me clarify this question. So as we've seen in the beginning of the presentation, the standardized approach has its roots in parametric VAR, but with regulatory correlations and regulatory volatilities. And for absolutely all of the right reasons. The standardized approach does not take volatilities and correlations from the historical data, because essentially doing so would take us, one step further toward the internal models approach, resurrect some of these data challenges that essentially we're trying to avoid by having standardized approach. So standardized approach, just because of its purpose of avoiding the data challenges of the internal models approach, is not sensitive to the volatility of, let's say, interest rates in one currency versus the other currency. It just applies the standardized average risk weight. So what happens there is that the capital requirement for trading very safe currency, which is highly liquid and also not very volatile, is similar to trading some extremely volatile currency that perhaps is not very liquid. However, desk risk, or if you just compute your desk value at risk, for internal purposes, would be a lot higher in this more volatile currency or more volatile asset and so forth. So what it means is that if you'd like to max out the level of risk that your trading desk would allow you to take without creating an onerous capital requirement, then you're essentially almost encouraged to go into more volatile assets where standardized approach becomes less conservative, just for the simple reason that we have a single risk weight across all currencies, across all equities and so forth within the category. And again, with an occasional square root of 2 multiplier for this specific specified currencies. Whereas you can take a lot more risk and hopefully get a lot more return by going into this more risky market. So the question is, does standardized approach encourage excessive risk-taking in most volatile markets just because it's not sensitive to the market? It's only sensitive to the type of the risk factor, not the specific risk factor. Anyone from the panel?
Well, I think, frankly, I think the question is a bit too narrow, right? Because it's not just encouraging trading in volatile markets. I think the problem is we're moving away from the Basel II concept that your capitalization should be linked to your internal model to your actual best estimate of risk, right? We're basically going back, not just in market risk, to a word that's closer to Basel I, where you have fixed risk weights essentially for the same kind of assets. And even if you've got an internal model under FRTB, because you're likely to be constrained by the standard approach, it even applies to firms that are running an internal model to some degree. So you're purely looking at capital. We're basically moving back to pre-Basel II world where you essentially incentivize to seek arbitrage, capital arbitrage, right? There should be other checks in place to compensate for that, but certainly the capital framework itself is no longer trying to align capital with risk.
Right. Exactly. Yeah. So, and again, I agree. I think that this is not something that is not one of these things that people just jump on the opportunity to have an FAQ because they believe that the regulation could be improved. Is clearly the consequence of not having this data requirement. So there is not much you can do about it. But yeah, I mean, the way it stands. If you're doing equities, essentially you can start doing options on penny stocks, right? Or some highly risky speculative investments, because your capital will be, if you're concerned about capital, because your capital will be exactly the same, no matter what kind of individual stock you're investing to, and you can take more risk and hopefully get more return. You hope, right? And given the same level of capital, so the capital essentially, or rather, standardized approach is extremely conservative for the safest investments, right? And it's less conservative relative to true risk for the riskier investments. So yeah, so it seems that there is this effect, and it's not clear if you can avoid it because basically there is no way to start differentiating between risk factors. without basically getting all of this data and stepping into this quagmire of having to now source all this data. But clearly, the committee, if I had to venture a guess, right, the committee clearly thought about it because that's what the list of specified currencies is coming from, right? So the risk weights were reduced for certain currencies. So that's kind of a measure to somewhat mitigate this, but it is not perfect because it's just specific list, right? Okay, so a question from my audience: is there a relationship between correlations that were observed during the 2008 financial crisis and the correlation scenarios that have recently been mandated by regulators, so GIAR? Very interesting question. Chris, can you venture a guess, like when you were designing when the committee was designing this regulatory correlation matrices? Where did they consider the correlation levels during the financial crisis, or was it just a conservative take on regular correlations?
Yeah, well, I wasn't around when they were actually when they're actually calibrating the risk weights and calibrating the correlations, so I can't say for sure off the top of my head, but I know it was based off of past data, and I'm sure that it was focusing quite a bit on the financial crisis. But the sense that I get is from looking at the formulas that the correlations themselves, the correlation scenarios were just kind of adjusted a little bit up, a little bit down, without necessarily explicitly calibrating it to the financial crisis. But of course, there's always this level of sanity check where you look at the outcomes, you see, does it seem reasonable?
All right. Okay. Thank you. Thank you. Right. Okay. So now this comes back to. Sorry. Go ahead.
Maybe one remark on that. This is not the observation I made in these negotiations, and there was a lot of up and down, obviously, on the risk weights. But I do remember there was this one point where everybody was shouting about the higher risk and the risk weights, which were too high for credit risk and credit spread, and that it would hamper the lending to the so-called real economy, because banks are not real. And then suddenly that was reduced, and the equity risk weight exploded. And if you were looking at the ratios between the standardized and the internal model approach for the market participants, you saw quite a bit of ups and downs, and a lot of that was unfortunately related to more political decisions than anything else of the kind, well, if we lower it here, then we will add it there. But obviously, there's a big risk that you are actually, hitting businesses which actually, number one, which play a very important role in the overall economic system, like, for example, FX risk. If you cannot hedge away your FX risk as a trading business, you have a bit of a problem. And on the other hand, you are basically disincentivizing certain business models which suddenly do not work anymore, and banks which are focused in specific markets. So this is what I had observed in these negotiations, and I found that quite problematic because, as Jochen said, we are basically moving away the capital requirements from the risk to the much more politically driven decisions. Alex, allow me to come back to the first question because I wanted to make one remark on that, and my Zoom crashed literally the moment I switched on my microphone. And this question about changing the trading business, my biggest concern is that basically the FRTB framework, in particular the standardized approach in its original version, it has been softened a bit, but not that much. The FRTB framework is disincentivizing specialized risk-taking. It disincentivizes risks which are less liquid and which are more specialized and more targeted potentially to the requirements of a specific market participant. That's on the one hand, certainly the correlation and the correlation scenarios in the standardized approach. And it's the NMIF regime in particular on the internal model side. Now, the big concern which I have on that is that basically you are incentivizing that you are selling, well, either you sell the client a proxy hedge, and you are now incurring a disproportional risk charge on your own books, or you are selling you're selling him the actual hedge which he needs, and you're getting a disproportionate charge on your own books, or you are selling him a hedge which is much easier for you and much cheaper for you to produce, but not necessarily as tailored to the requirements of the clients as it would be if you wouldn't have these capital restrictions, right? And the risk with that is that suddenly, take an airline, right? It's much easier to get Brent liquid and jet fuel, right? So what do? If you're selling your airline now Brent, what's happening? Well, all of the airlines suddenly have a very directional risk sitting on their books. They actually do not necessarily have the infrastructure to monitor this risk between the hedge they have taken and the exposure they really have. So basically, you're pushing in the intent of avoiding, well, these risks building up in the banking system. You are pushing them out into the rest of the economy, where they are much less controlled, and also where the risk where they are typically much more directional. They are much less likely to offset in a market participant who is hedging a certain risk, because these risks are very, very often directional. Like in the airline business, right? So I think that is the real problem which the FRTB framework is producing. Let's face it, the key purpose of the banking system is to diversify away risk, to buffer risk through the capital buffers and to diversify it away, right? And if you are disincentivizing this role of risk taking and taking these risks on your books, you are automatically reducing the capability of diversifying them away in the overall system. And that may actually result in these risks piling up somewhere else.
Okay, thank you, Thomas. All right, so and actually, I wanted to go to the question, another question from the audience, because I think it just comes, right on the heels of your comment. So, will the question from Howard, will the residual charge for exotic underlying and payoff be mitigated by the internal models approach? So, so here, essentially, the question is, we talk about the residual risk add-on in the standardized approach. And one of the forms of this residual risk add-on is a risk add-on for the exotic underlying. And I would like to invite Chris, if you can comment, as I'm an expert, on what replaces the residual risk add-on in the internal models approach. How does that work? And how does the capital for exotic underlying, essentially trading anything that's not a vanilla option, will compare, between IMA and the standardized? Chris?
Certainly. Thank you, Sasha. I mean, of course, broadly, the view of the standardized approach is to have something that's going to be more operationally simple. And when you have a more complicated situation, something like an option with an exotic underlying, for example, then you don't necessarily want to incorporate something that's more operationally difficult in the standardized approach, and you just have the residual risk add-on. So within the internal models approach, you build your models, you explicitly model all of the different types of payoff structures that may not be vanilla option, and then you're able to directly calculate that based off of the different, you'll be able to explicitly calculate and estimate the expected shortfalls and aggregate up as all of the formulas under the IMA would require. So essentially, your model can directly calculate that, and then you can apply it to all of the formulas we have in place.
Okay, thank you. All right, thank you. And with that, we go to the look-through approach. So we have a general question in the workshop, but also there was a participant question. So the workshop question that we put ahead of the workshop on the list is: do you anticipate difficulties with the look-through approach? And this is a very general question, but from the audience, we have actually a very specific question. So I wanted to invite the panelists to answer both the general question and the specific question. So the specific question is the following. So what about, basically the question is, if you have commodity ETF inside an equities book, is there room to choose which class to capitalize? In other words, do you treat it as an equity on the index underlying, or do you do look through? And then how does it exactly work? So in other words, if you have an equity exchange traded fund, but the underlying of this fund is actually, let's say, commodity, or there are all kinds of ETFs that on underlying that's not an equity index. So how does it work? How do you do the risk charge? If there's so the question is if there's a commodity inside the ETF, do you apply the commodity risk weight? How do you apply the correlations and so forth? So can anyone from the panel comment on exactly how it's done? That's a lot of, I know a lot of people struggle with how this is supposed to work.
So I'd be happy here, please, after you.
Go ahead.
Oh, sure. I'd be happy under the current Basel text. Obviously, as the look-through approach, you want to act as though you directly have it on your balance sheet. So under the current Basel rules, you need to make sure you can look through sufficiently frequently. So ideally, if you are able to look through, and that is a little ambiguous right now, and we recognize that and have been discussing that, although I can't comment further about exactly what's coming out. But essentially, if you are able to look through, then you act as though you have it on your balance sheet directly. So in the case of a commodity ETF, you look through and it's as though you directly own those commodities. Now, if you're not able to look through, there are several approaches you can take. So it reverts to the standardized approach. There's one special case where you have it as an index, and then you can have one special treatment. If it's not following any sort of index, you can use a mandate-based approach where you look at the mandate of the fund and you assume that it's investing whichever way is going to generate the maximum capital requirement. So there you might look at the types of commodities it can hold. You might imagine the ETF is holding, you assume that it's holding whatever commodities attract the largest risk weight and act as though that's on your balance sheet. And then the final, most conservative approach that's the simplest operationally is you can put it inside the standardized approach other sector equity bucket. And that's going to be the easiest approach operationally, but it also tends to have a very conservative treatment in terms of risk weights. And so that's how something like a commodity ETF, for example, would be handled. Anyways, okay. Please, Jochen, you were saying something.
Just a clarifying question. So it seems that in the 2016 rule, you always had to look through, and in the 2019 rule, you're able not to look through if certain conditions are met. But with respect to the same question for the commodity ETF, so it's clear if, let's say, you have an index and you say, okay, so equity index, let's say your ETF on this S&P, it's clearly you have the right not to look through. It's all positive weights and so forth, right? If we're talking about this criteria. On the other hand, if let's say there's a factor investing, and factor investing is an investing style in which you buy certain investments and sell certain investments in order to achieve, let's say, you go value or you go momentum and so forth. So clearly that violates this requirement of same direction of the sensitivity, and that's clearly intentional and seems the right thing to do. Now the question is, if so for some of these more esoteric ETFs, a commodity ETF, you would think, has the same sign because they would be owning perhaps some commodities as well as some commodity producers or companies, right? So let's say there may be some mining companies for gold, but there may be also some gold. So you think it would have the same direction, but it's not as obvious, right? I don't know if this is something that potentially can backfire where you're looking at the ETF. And it's not obvious if this ETF meets this criteria about the same direction. So do you anticipate that ETFs may fall in and out of this criteria where you're able to look through and suddenly you can't, just because they invested in something just happened to have the opposite sensitivity direction, perhaps even to hedge something else that they have?
I mean, we certainly broadly don't want to have situations in which products are quickly falling in and out of look-through. I don't imagine that we'll see that being a problem in practice, although I'm not sure what else I can say about that right now.
Okay, thank you. All right, I want to turn it back to the panel. Anyone else would like to comment? Jochen, Thomas?
But it's also the other complication that although the Basel Committee allowed non-look-through in certain cases for the sensitivity-based approach, they didn't actually allow it for the default risk charges. It's actually quite interesting. I don't think they've come to a resolution on that one yet, right? So if you've got an equity basket that you can't look into, you can treat it as an index in certain conditions, but you still have to do you're supposed to do the default risk charge on that equity basket as if you could look through. I'm not sure where that's going to end up. I mean, it could just be you let the whole index default, which is then a massive overcharge compared to if you could look through. But that's actually still an open question that I recall being very hotly debated until recently. Right? I'm not sure where we are today. But that's going to be an interesting one to see how that plays out.
Thank you. All right, okay, so let's go to the next question. What do you expect to cause the greatest variation in a standardized approach capital charge between banks? Right, there are a couple of options there. So one is, various, you can make various choices there. One choice, for example, is you can use zero rates, or you can use, or rather, you have to use the rates that your risk unit uses to report risk. And this may be either zero rates or term rates, such as swap rates. So that clearly has some potential for, upsetting your, finely tuned balance of hedges in different ways that perhaps can result in different capital. And the other thing is, the base currency choice, right? So if you're allowed to change base currency, let's say that if you're in economy or market, if your domestic market is such that, let's say that for foreign exchange, your currency does not have liquid crosses to other currencies, then perhaps you can use a different base currency. If perhaps, so it's the foreign exchange, right? It's also CDS. If you don't have CDS denominated in your currency, but you have CDS denominated in a dollar, then it's easier to use dollar as the base currency. So, two obvious potential sources of variation across banks is the choice of term versus zero rates. Swap, versus or instrument versus zero rates for the vertices, and the choice of the base currency. What else is there, and what, in your opinion, would have the greatest potential to essentially upset the level playing field, where some banks for the same portfolio would get different levels of capital than other banks if both banks use standardized? The panel, anyone wants to comment?
Let me maybe start. I mean, you've already mentioned the things that are not well defined in the standardized approach, right? The sensitivities, in particular rates that are being used. If you look at that, the biggest uncertainty is the risk add-on, because it's hardly specified at all, right? You've got some rough idea, okay, if something hedgeable, but then you are supposed to be able to exclude anything that can be hedged with a linear combination of vanilla options. Because what is a vanilla option? Not every market trades European options as vanilla. Some trade on Asian options as standard options. So you could have a choice to say in those markets I trade the Asian option as vanilla or not, right? Second thing is, what's the finite linear combination? A digital option you can reproduce as a limit of a finite linear combination. So if you suddenly book it as a ramp, right? So you can effectively take it out again, right? Depending on your booking model, so you can start playing around with the booking models to say, okay, if I don't book my digitals as digitals, but slightly overhedged, which actually most banks do anyway, right? And they could fall out again, right? And you can continue those little games, right? So I think depending on how you approach the residual risk, then there's a lot of scope for coming up with very, very different answers. Yeah, I mean, I think the other uncertainties really depend on, I think the rates one, you will certainly get differences, but given that your rates book is hopefully hedged, right? It should not be such a huge difference if you take different opinion. But okay, we still get differences. Yeah. But those have been, to my knowledge, been relatively well tested by test portfolios in the tested PRA have been doing. So I don't think on the vanillas you get that much of a difference. But I think on the exotic trades, I really don't want. I really think we could have massive difference.
Okay, thank you, Jochen. One thing actually I wanted to also raise here, if we have time just for a few minutes to talk about it. So one thing is that standardized approach seems to set correlations to really high positive values. The thing is, some of the markets, they're like asymmetrical in terms of, some investments are basically X to someone and 1 over X to someone else, right? For example, foreign exchange, right? So foreign exchange, depending on which it's currency in the pair. So there may be a pair, right, which is essentially a market convention for the foreign exchange, is to put the currency pair in a direction such that the FX rate is more than 1, right? So nobody's quoting 0.00 something for the yen, right? People are quoting numbers larger than 1 for the foreign exchange. That's kind of somewhat arbitrary. The thing is, a lot of this regulatory correlations, and this would not have been a problem for IMA or for that matter, historical VAR or parametric even VAR. But it does have a problem if you prescribe correlations which all tend to be high positive, right? So the question is, are there any trades which basically depend, whose sensitivity direction depends on which side you're looking from? Right, so you must be looking from the point of view of one currency or point of view of the other currency. And the latest regulation actually allows you to create synthetic crosses, right? Which is 2016, you couldn't create synthetic crosses. So here you can take 2 liquid foreign exchange rate and create a synthetic first order cross, which is then permitted to be treated essentially as a liquid FX rate. Or the basis curve, right? So the basis curve, there's a market convention. But on the other hand, basically, if I'm in a dollar and I have a euro versus dollar cross currency swap, if I'm in the US, the euro to dollar swap basis spread is minus of the spread that I have, if I'm on the other side. So the question is, do you anticipate? Is there anything in the regulation for which the regulatory method does not take into account that there may be an upside down view depending on which currency you're in? Anyone from the panel, from the audience?
I think the question is, after all of these conversations, we now have loads of features in the regulation which allow us to actually neutralize these effects so that we are what we call a level playing field. But the question for me is also, is actually the playing field level in reality? If I'm funding myself in a different base currency, then obviously I do face a different risk, right? And haven't we overdone it on that end? I have seen very strange effects when you are on the VAR side already. When you switch the base currency, and you find that actually your risk goes up tremendously, and not because of the positions which you are not considering, but because of the correlations between between these other currencies which are involved, and in particular the pattern under which these currencies are behaving in a crisis, because that is what is actually determining your VAR and your maximum losses. That's not necessarily the same as your overall correlation, right? And I think that is a little bit of a problem, which I see, that yes, it's nice to have a level playing field, but is that really reflecting the reality of the risks the banks are taking?
Okay, thank you. All right, thank you for the comment. Yeah, so okay, so now we're almost at the end of our time. We also have these participant questions. However, tomorrow we're going to deal with, we will benefit tomorrow from the background that we covered today. So tomorrow I anticipate we'll have more time for the panel, more time for the question. And what I would propose to do, given that we're at the end of our time, is to wrap. We covered almost all of the workshop questions except for a few general ones in the end, which are somewhat open-ended. What implementation difficulties, data from the trading system. So what I would like to do is to wrap today's session at this point. And tomorrow we'll combine the participant questions that we have not addressed on the standardized with the questions on MAR50, the CVA document. And we'll have a panel tomorrow in which we address some of these participant questions, as well as questions on CVA. So with that, it's 11 a.m. in the United States. We spent 2 hours, I believe, very productively working. A lot of people logged into the workshop. So thank you very much for joining us. We will continue on day 2 tomorrow, same time. The first part of the workshop session tomorrow will be the CVA document, and then we'll go on to a panel. We will take participant questions. We'll take, we have a set of workshop questions that we posted on the website, and we will cover both standardized for the trading book and standardized and basic for CVA in a panel tomorrow. All right, so with that, I'll turn it back to organizers, if you have any announcements related to the conference. And finally, one last thing I wanted to say is that there was a question whether we have an Excel, about basically having an Excel example in which the methodology is demonstrated. We actually did prepare this sample. And tomorrow we hope to have some time just to demonstrate it, and we'll make it available for download. All right, so with that, thank you for joining us today.